Have you ever seen gas prices jump drastically overnight? One day, you're filling up your tank, and the next, your money just doesn't stretch as far. That sudden spike, along with rising grocery bills, mortgage rates, and soaring utility costs, is all driven by inflation. But what if prices started falling, along with job opportunities and businesses start collapsing? How can you make sense of these shifts? The answer lies in one key report, the Consumer Price Index, or CPI. It's the report that the Federal Reserve watches closely, that investors obsess over, and the one that can influence everything from the cost of eggs to your ability to buy a home. Are you paying attention to what this number says about your future?
Hello and welcome back to Pocket Economist. Whether you're a trader, investor, or someone passionate about personal finance, you've come to the right place. Here we simplify complex economic concepts and provide actionable strategies to help you grow your wealth. From market trends to practical investment tips, our goal is to equip you with the insights needed to make smarter financial decisions. If you're ready to enhance your financial strategy, be sure to subscribe to the channel and hit the notification bell so you don't miss out on our next episode. Now, let's get started. If you want to know what direction the economy is heading, there's one number you can't afford to ignore: the Consumer Price Index, or CPI. When this data gets released, markets react fast, and for good reason. It's not just another statistic, it's one of the most crucial indicators of inflation, influencing everything from your daily grocery bill to the Federal Reserve's next move on interest rates. But why does this particular report command so much attention? Let's break it down. The Consumer Price Index measures the average change over time in the prices that consumers pay for a basket of goods and services. This basket includes everything from food and housing to transportation and medical care. Essentially, it's a snapshot of how much more or less you're paying to maintain your standard of living. Think of it as the economic thermometer for inflation. Rising CPI means inflation is heating up, while a cooling CPI suggests prices are stabilizing or even dropping. Now, why does this matter so much? CPI is one of the most watched indicators because inflation is like a silent tax. It erodes your purchasing power. When prices rise faster than wages, you can buy less with the same amount of money, and that impacts everyone, whether you're running a multi-billion-dollar hedge fund or just trying to stretch your paycheck to the end of the month. It's why every trader, investor, and policymaker closely monitors CPI numbers. So, what happens when CPI is released? First, let's talk about the market impact. Picture this. It's the morning of a CPI release and traders are on edge, watching their screens. Why? Because CPI can dictate the future direction of interest rates, and that's a massive deal for the markets. If the CPI comes in higher than expected, it signals that inflation is running hotter than anticipated. In response, the Federal Reserve might raise interest rates more aggressively to cool down the economy. Higher interest rates mean borrowing becomes more expensive, which slows down spending and investment. Businesses face higher costs, profits shrink, and stock prices can fall. On the flip side, if CPI comes in lower than expected, it can suggest inflation is easing, giving the Fed more room to keep rates steady or even lower them. Lower interest rates typically boost the stock market as borrowing costs decrease and corporate profits improve. That's why traders and investors hang on every word in the CPI report. It's not just about the numbers, it's about how those numbers will influence the Fed's next move, but it doesn't stop there. Different components of the CPI report reveal how inflation is impacting various parts of the economy. For example, if prices for energy or housing are surging, that could spell trouble for sectors like transportation or construction, which are highly sensitive to those costs. Investors in those industries may see stock prices tumble if costs rise too much for too long. On the other hand, a drop in certain categories like food or clothing might signal inflation is being contained, which could boost sentiment in those sectors. It's also worth noting that CPI is a lagging indicator. It reflects price changes that have already happened, but traders use it to make forward-looking decisions. A high CPI reading might lead them to sell off riskier assets like stocks in anticipation of tighter Fed policy. Conversely, a lower than expected CPI could spark a rally as traders bet on more favorable conditions for growth. Beyond Wall Street, CPI has implications for the broader economy. If you're a business owner, knowing where inflation is headed can help you make critical decisions. Should you raise prices now? Or can you afford to keep them stable? If you're a consumer, CPI gives you a clue about how much further your paycheck will stretch in the months ahead. And for the Fed, CPI is a key input in its decision-making process. The central bank is always balancing two goals: keeping prices stable and maximizing employment. CPI data helps them figure out how well they're meeting that challenge. So why is CPI such an important event on the economic calendar? Simply put, CPI drives decisions that ripple across the entire economy. The number can move markets, influence interest rates, and provide a snapshot of the inflationary pressures affecting both businesses and consumers. Investors use it to gauge the risk of holding certain assets. Companies use it to adjust pricing strategies, and policymakers use it to shape the future of monetary policy. In the fast-paced world of finance, where information is power, CPI is one of the most powerful pieces of data you can get your hands on. So what should you do with all this information? If you're an investor, keep an eye on CPI releases as they offer clues about how the Fed might adjust its policies. Watch how the markets react. Stocks, bonds, commodities, even currencies all move in response to these inflation reports. If you're not in the markets, pay attention anyway. CPI directly impacts your cost of living, and understanding where inflation is headed can help you make smarter financial decisions, whether that's timing a big purchase or adjusting your household budget. Every month, the financial world holds its breath on a specific day, CPI release day. Typically, the Bureau of Labor Statistics drops the Consumer Price Index report at 8:30 a.m. Eastern Time, usually around the second week of the month. This timing is crucial because it gives investors, traders, and policymakers a fresh look at inflation trends right as the markets open, allowing them to make decisions in real time. By 8:29 a.m., traders are glued to their screens, positioning themselves for what could be a market-shaking moment. At 8:30 a.m. sharp, the CPI numbers hit, and within seconds you can see reactions ripple across the financial landscape. Stock futures spike or drop, bond yields adjust, and currency markets can see swift movements as global investors digest the new data. Why this exact timing? It gives markets the chance to process and react before the opening bell at 9:30 a.m. For those on Wall Street, it's a critical 60 minutes, an opportunity to reposition portfolios, adjust hedges, or make trades based on what the CPI reveals about inflationary pressures. For everyone else, it's the moment when the latest inflation data becomes public knowledge, offering a direct insight into how much more or less we're paying for goods and services compared to last month or last year. Remember, the release of this report doesn't just set the tone for that trading day, it often influences market sentiment for weeks to come. So make sure you mark your calendar for that next 8:30 a.m. release. It's one of the most pivotal moments in the financial cycle. Stay tuned for more expert analysis and timely economic updates. With inflation remaining one of the hottest topics in financial news, we'll continue to break down what the numbers mean and what they could mean for your wallet. Thanks for watching. And don't miss our next segment on the economic trends driving global markets. If you found this information helpful and you want more insights into how big economic reports affect your personal finances, subscribe to the channel and hit the notification bell. We've got plenty more content on the way to help you make informed decisions in this ever-changing economy. Thanks for watching, and we'll see you next time on Pocket Economist.